Welcome, traders, swingers, scalpers to Inside Traders. This is a finance show where we talk about what the inside traders are buying and selling every day. And I'm here with our Mr. Jerome Powell, the market maker, the man who sets the fate of the markets. For tomorrow, he will decide whether it's a bloodbath, which is what he did last year, or if we see green on the screen. And so, yeah, it's interesting. The Fed's job, wouldn't exactly want to be in that position. But he does it with, he does his duty, and we appreciate that. I actually really do like Jerome Powell. Let me just rant on him for a second while I let you guys see what people are buying and selling. First of all, we do need some kind of system for managing expectations. One of the things that I heard somebody say about the inflation rate being 2% being arbitrary is well, yeah, it doesn't matter what the number is. It matters that everyone knows what the number is. It's not important that the number's -2 or +2. It just has to be the same for everyone. And so that way everyone can build that expectation into their, economy, basically, is one idea. And it's not like I understand that too well, but here's what people are buying and selling. Man, was it quite a day. I got toasted. I lost premium. They caught me with my pants down, I let it happen. And so I was midday, I'll show you this trade setup. There's so much to talk about. So midday, I'm working on a new system that I want to show you guys. Okay. This is, oh, that's funny. You can't see green. Oh, that's so funny. So yeah, I'm working on a way to get better pricing with my trades. And a lot of that has to do with timing. So if you're using Robinhood to place an options trade and you're trying to actually be precise with a level like this, we'll get back to the flow. Let me just talk to you about this. So let's say right here, these are all these lines. We got a lot to talk about. So let's say right here, you're I'm calling it 230 is the bottom. You'd be wrong because they're well, yeah, in post they're 228 or something. But let's say you were I'm calling it 230 is the bottom. Okay. So you want to go and enter an options trade, and you go in with your fat fucking fingers and fudge the numbers up. And then by the time you hit enter, the dialogue is can't submit, or maybe you just go too low and it doesn't fill, or it's hard to place orders. It is difficult. That's work. And so, or today when the market, I'll find this candle. I haven't even looked for it, but I guarantee there's going to be a giant candle. Yeah, there it is. This sell-off. Oh, wait, was this morning? Okay. So we sold off right away, but then this, it must have been, it's not that bad actually. I saw this high volume selling. I did see that. And this was the time to take profits, because obviously this is why it was such a sweet setup today and I missed it. I could have, my system. And so I couldn't fully participate in what was happening in trading while I was developing this system. And so this was such a sweet setup. Down here, we had this really strong rejection off the 228, which is where we're trading now. And then you just see exactly what you would want to see if we were really in a good bounce up, which is follow through from the buyers, higher highs and everything. And so the bulls get max confidence around 10 a.m. my time, which is not that far off. Anyway, the bulls get tons of confidence from, look at how clear these levels are. Higher high. Even when we dip down, it's still higher. Green candle brings us back up. Boom. Even this is still there's a line there. You could see that line. And so we have a bull run, boom, 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 boom. And this is right where you want to start selling freaking puts, or selling calls and buying puts. Why? It's because it's the previous ceiling after the tank this morning. And so all of these patterns are real. Like this is like not made up at all. So look at that this morning. Where would you have known to start selling calls and buying? I fucking knew. I did sell a couple, just not enough. And so, yeah, like, how would you have known where to begin hedging? Okay. You would hedge where you got rejected last time. So we crashed down and found support at 233, and we get this big green candle up, but it can't penetrate past 234.43. And then it's actually 234.7. See lower low. You see that candle, you're like, fuck. And then 234.10. That's kind of confusing. Then we see this last ditch effort on 234.03. No, that can't be right. What's the high? 234.77. So right there's your level. And that's right at the top of the Bollinger Band. And it all lines up perfectly and magically. It's awesome. So one day I hope to be able to capitalize on all this. But today was not that day. And so the original question was like, how would you have known where to hedge if you're looking at the minute to minute level? I'm talking about day trading here. This is why we need like the best execution time with the exact bid-ask spread midpoint. So you have a buyer, they're saying, I want to buy, bid, right? Like I'll bid that. You're at an auction. I'm going to bid on it. And then you have somebody who, oh wait, no, which one is it? A bid or an ask? Like, oh, now I just confused myself. All right, GDT. Oh, it's hard to do this stuff live. GDT, tell us what is a bid versus an ask and how to remember. I thought an ask is like I'm asking for it. Like, no, that's what I'm like. Yeah, anyway, whatever. Let's see what GDT says. So the bid is the highest price that a buyer. Yeah, so bid is like I'm buying it. So bid, and then ask is like the confusing one, I think. But I did have I had it worked out before. I'll see if I can remember. Anyway, bid is buy, ask is sell, but ask does kind of make sense in some contexts. So back to the chart. So we're crashing down and it's blood. And first of all, I was feeling so good about this. Because I was feeling like I missed out on the rally. And so down here, I'm able to like participate and get some good puts sold around here, I think. And then down here, and you're just playing every line, puts and calls. And anyway, and then we had this giant rally. And this was the time to not do like scalping. This was the time actually to take a small amount of profits, which maybe I did, and definitely like more hedging. Why? How do we know? I already told you, but I have to say it again so you remember. How do we know? How do we know right here? Why not right there, right? Like why right here? It's because this was the previous level. And as we're getting close to the previous level, as in within like 30 cents, the sellers are going to start testing. And then they didn't even do that great. Then we had this other, right? Like then we got us back down to like 230. I want to be a seller. I'm not picking sides. And so this is probably a line I don't have here because, and where you don't want to do anything. This is actually one of the best things I think I've learned as far as like shortcuts. You just definitely don't want to do anything in no man's land. You just wait for a top or a bottom. And that's where you're at least going to get like in that magnetic price level that everyone else is participating in. And you're probably going to have like less churn because it's less random. You're going to have like a quick outcome. And so, but yeah, I mean, we didn't even sell off like that crazy hard. We're at 230. We were just at 212 on Monday. Was this Monday? No, that's yesterday. So what do I think? This is kind of not unexpected at all. I mean, we opened with Mr. Chairman at the Fed, Jerome Powell, talking about, what it is. I just don't know what people are going to say. I think this, or like what people think he's going to say, is it going to be like, hey, here's something really unexpected that nobody had considered when nothing has changed. And I know that everything I say is like being analyzed and there's drinking games and people are playing. Anyway, like they're going to be careful with their words. And the question I have for the Bears, this is why it doesn't look that bearish to me. The question I have to the Bears would be like, what new information do you think he's going to say that he hasn't said? His whole thing is like not surprising the markets. Anyway, whatever. So like, I think this is actually just smart hedging from what I had on the screen to begin with, the order flow into these guys. So if you look at the stocks, it was pretty good action. And this is how I'm interpreting the moves of the smart money today. They buy up whatever they think is cool, Nvidia, Tesla, and they hedge with the ETFs. Tons of calls into SQQ, tons of calls into TQQ. That's kind of interesting. That's like a reverse hedge. That's interesting. Because SQQ is the inverse levered at, I think, 1.5. Maybe it's 3. It might be 3. So like an option on that is 30. You'll feel that. So SQQ, TQQ, ARC. Yeah, that's awesome. Good. I didn't see that. But yeah, I think what people are doing is they are they're putting their premium into whatever names. They are, interestingly, tons of puts against Apple. I think there's something different going on with today's action than we normally see. And if it was anything, it would have to do with the Fed's like meeting tomorrow. The Federal Reserve is the like non-government agency, I guess, that is like was made up by the banks so that they could do whatever they want, but not really. I don't really understand what its role is that well, but I know they make the rules. And one of the big rules that we all have to play by is interest rate. And so like that impacts everything. You would be shocked. And so we are going to hear more about like the kind of current state of the economy or whatever. But like, again, to the Bears, first of all, we all want ostensibly, right, the best outcome, which is going to be the most people generating sustainable money in a thriving economy that isn't being where people still have really strong purchasing power and their cash means something, and the currency is stable and strong, and it's seen as the first class common currency of the world, right? So like we all want that, and we should do whatever actually does make that happen. Can the government be trusted to do it? Definitely not. That's why we have the Federal Reserve. I don't think they are a government agency. Let's ask GDT. Oh, wrong one. Hey, GDT. Wrong one again. GDT. What is the Federal Reserve part? I gotta move this so I can type. Government or not. Dead air. Hey, what's up, dude? The Federal Reserve, often referred to as the Fed, is our central bank. And I think central banks is an interesting idea. You see them in Game of Thrones. It's a complex entity, independence. They operate independently of the federal government. Yeah. But they are a creation of Congress. This is insider shit. This is like everything this show is about. We want to know how they operate, what they do, why they do what they do. When the bond market goes up, why does the stock market shit the bed? Language, come on. And like, how do we capitalize in the same way as the big boys, which is these guys? And so I think I did see a pattern today in the action. Let me see if I can like tease out what I'm thinking. I think they're doing smart hedging where they basically lock a bunch of capital into really valuable puts. And I would say a put is valuable when you know that a large change in the stock price. I would say there's two reasons to buy. Anyway, there's a lot of reasons to buy puts, but like one reason is you want it as effective insurance to hedge from your portfolio going any lower. If you're hemorrhaging cash, if you really just need to stop the blood, what you really can always do, and I never do, but you can do it, it's very easy, is it's hard for me to do it. Other people could do it easy. Is you could just buy like the 0-day expiring puts for today. And that would give you a really cheap insurance policy that is going to have zero extrinsic value in it, zero time value in it. And everything is like, the terms are all complicated here because everything has an opposite. So you never know if it's like that or it's opposite. And so, yeah, anyway, there's a ton of reasons to buy puts. You could buy like a 0-day option and that'll definitely stop the bleeding. It will certainly do that. And then you can buy a long-term, like high vega, as we were talking about, leap put, which is like a dumb acronym that we should just obliterate. Let's not even use it. A put that like expires in a couple of years. And then just like a long-term put. And it's going to be way more expensive because it's all time value. But because it's all time value, it's less reactive to the stock price. Now, everything influences it. Moneyness and time and interest rates will influence it. It's all connected. So yeah, what do I think they were doing? I think that they put their premium into the companies that they thought would do well, and then they use the giant QQQs and the SPYs to hedge. And so if something does go wrong with those companies, they have like, they're being held up by those puts into the SPY and QQQ, who altogether may also languish or whatever, but it'll be a lot like less volatility. And so these are the kind of things that, like, going back to today, I knew exactly what today was, you know. It's not like it wasn't a mystery. I pay attention to this stuff a lot. So I knew the Fed was speaking, blah, blah, blah. And right here, what's so satisfying though, what I love about this, and I don't even care about not capitalizing perfectly, is how well this stuff actually does work. You can play these levels, and you want to know where the real, like these lines, the day started with no lines, and I would add the lines kind of as we'd get to like different points. But you can see at the end of the day, it just looks so neat. It's like, yep, it's a layer cake, and as we approach the ceiling, the layers stack more frequently. And what does that mean? Okay, what does that mean to me is like, see how these bars are really wide down here and these stack a lot closer? I think this is no man's land. So like if we go much below 230, then we're locked back in the box. Right now, we broke through. We were escaped from it. And we still kind of are, as long as we're above 230, but we were at 228 in close. So who knows we don't know. Nobody can know. In fact, it really will be determined by the words of the Fed, by their guidance, because if there really was some new like crazy info that nobody knew about, that would shock the markets. And so you should have your puts ready. And that's what I'm talking about. Is like, we got to be able to infer based off of the price action, the motivation. And if that makes any sense, because everyone is so opaque with their trades, we can't like just look at their order book and see what and why. And I think that they would be even more opaque if they could. So look at this big red volume bar. Oh, I thought I had a mute button on. YouTube, don't be mad at me. There we go. So we have this big red volume bar. And what is that? Is that real? So the question is, what are the market conditions? Because we're going down, 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 down. And then we have this hard rejection off of 212. Let's look at it. We've seen it already, but it'll be worth seeing. Okay, yeah, look at this gap. So we haven't been to this level since I've been doing this line thing, I guess. That's funny. And so, but we do have 212 and then 214. And this would be 250. It's like every dollar. But still, like the lines line up. And so let's make a longer view here. So we barely just had this bottom, and we have this really strong buying reaction. And it doesn't quite seem bearish to me. I just can't see it. It still seems bullish if I'm just looking at it. It looks bullish. Maybe I just always see bullish, right? I don't know. And so bearish to me wasn't even like when we had this huge sell-off today. That was smart. That's what everyone should have been doing. And it's almost like the market was giving you a gift today. And if you were like paying attention and prepared enough to be able to take advantage of it, then that was great. And if not, then maybe better luck next time. But this was the gift. The gift was getting back to test this high. So here's what it says to me. This says there's a ton of interested buyers. And as soon as they see that we're in a technical buying environment, which is like their job, like as soon as they do what they're supposed to be doing, which is like looking at the actual levels we're at, and they see that we're making higher highs, and you can just look at the slope of the Bollinger Band, and the Bollinger Band will tell you a lot. And then they start participating, and so the buying pressure drives it all the way up to this ceiling, and then we come back to like 232. And we have a ton of selling into close, but that's because at this point, here is where the day failed. This is where ostensibly I should have like reacted more, but like anyone would have taken money off the market. Do we have a vertical? Nice. So the line in the sand is here. Post that. We can even watch this, I think. Let's try. Oh, that's so cool. Okay, so this is the low of the day ish. Let's just go right here. This is when the buyers get motivated. And then play. So yeah, this is the buyers. We have this big run up, and that triggers sellers, but the buyers are like, we're freaking going. There it was. These giant green candles. This to me shows that there is powerful and interested buyers at the price level of 233, right? That's what that says to me. And then the sellers are like, fucking no, language. Don't do that, buyers. And so like we keep going, and then it's kind of a war, and this is actually not no man's land. This is a great place actually probably to buy, but then we did go down. And so what is this? Okay, this is, we don't need the replay. This is the buyers still like having some enthusiasm, still having some optimism. We get some big green bars, but we can't break 233. And what happens? They get exhausted, right? So like it's 233, we broke it. They locked us back under 233. Let's get some bars and break it. And we did with this one. High of 232. Anyway, you just look at it. Who cares what the numbers are? And so, but then the sellers punch us back down. Are we locked? No. See, this is super bullish right there. Check that out. If I saw that and I had this line already drawn, I'm sure I didn't, but had I already had the line and I saw that, I would be buying. And so they do boom, 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 boom. But then again, rejected. Actually, no, we're making higher highs. Wow. Okay. So this was a pretty bullish day. This was a bullish day. That's what I'm looking at it as, because we got all the way up here to 233, which is basically a higher high consistently again. And then, this must've been where I noticed that like high volume selling. Somewhere I saw just like, on the tape, it was just like puts. On my monitors, it was just like a flood. Like everything came in at once. That's why you need a button to be like bucking hedge, right? It just all happened so fast. And so this is like the smart money. They had deployed all their calls into the companies, and maybe they even took profits or whatever intraday. And now they're going to lock in that gain with a really valuable put on a ETF, where even if there's like a crazy reaction to market to the Fed tomorrow to the upside, like it's anything is possible in markets. The price can double or fall in half at any second. That's what's so crazy. Especially in Bitcoin land, but well, maybe not even especially. And so, yeah, where were we at? 230. So we were at like 228 in after hours. And the question is, where are we going to end the week at? I think probably higher. I think we're bullish. I think unless the federal, unless Jerome Powell intentionally dumps on the market, which I don't think he would. What is the outcome we all want? If that is the outcome and the data is the data, like we're getting there, we're doing it. Like let's fucking go. And but like, let's also take advantage of price declines. And so I just think we have to try one more time for 240. I think we have to try for it. We could fail, whatever, but we got to, give it a shot. And that's all the way up here. Like that's a far way away. And so I think we probably go lower on the open because more fear and, just like people like forgot to hedge or whatever. So I think we're like a little bit lower in open, and then we'll do the test mid-afternoon. You want to know why? Because it's options day and they all expire on Friday. And so what's crazy about these 0 days though, they get so volatile. They get so volatile on the Friday. And the volatility gets split up. So like if you were to look at the whole contract of an options contract for like a month, all of the volatility is in the last week. If you were to look at all of that, roundabout, if you were to look at that volatility, all of it would be on the last day. If you were to look at all of that volatility, really the last 3 days, and then of that, the last day. And then if you were to look at that one day, all of the volatility is in the last 60 minutes of trading. It's crazy. the price swings are enormous, 1,200%. You know, it's why, like, if you get locked in the box before your options expire, like, you can have such a different outcome on that expiry day. That expiry day is everything. And so you got to be like 1 week, it can make all the difference. And people know that. They know that. And so, it's pretty clear how volatile these can be. If you just look at, the percentage change over a night or whatever. And so you generally don't want to be like playing around with, I think, options unless you can give it a lot of attention because of that factor, volatility. So, let's go look at some of their trades. That's kind of like, I don't know how to like justify my idea there, but, one thing is that when I was looking at the tape, I did just see them all come in for SPY and QQQ at the exact same second. It was like down to the nanosecond. I could probably find it in the logs. And so, it was just like a dump of SPY and QQQ, and the premium on that side like doubled or tripled or whatever. And that's because I think they take a ton of cash and they lock it away in the put for insurance. And they're not like with a call. Maybe that is it. Okay, let me see if I can translate it. With a call, I need to, be able to enunciate clearly. With a call, you want the price to change a ton. Like your whole thing is I'm going to bridge this gap. The price is here. It should be here. That's where we're going. Even if it's an inverse call, you still are expecting a large change in the price. With a put, that can be very much the case as well. Puts will bloom as well as a call. Double, triple, quadruple in seconds, especially 0 day. But really just if there's a big move. And so what's the difference? The difference is when you're buying deep in the money and you're adding a ton of extrinsic value, it's really smart to do that with puts. Really smart to do that with puts because you're essentially locking up capital in a device where it's impossible to lose, assuming you're using the put right. And by what I mean by that is like you're going to have that much money either in your portfolio or in the value of your put. And if you need that much money for, I don't know, a day, a week, a month, a year, then it makes a ton of sense to lock it up in that insurance policy until you don't need it anymore. But these contracts like have a big time decay cost. And that's another thing that we need to talk about in the fullness of time on this show is the Greeks and how pricing works and how we need to manage for all of it. And one of the things that must be managed for even more than delta is theta. And so theta is the rate of decay of your options contract. And you do not want to be holding a lot of expiring contracts while the market is going down. Like they will get locked in the box immediately and never be resurfaced. What you want is like we were talking about finding the perfect options contract. You want something that is actually low volatility. In a contract, you want the lowest volatility possible. But let me tell you, if that underlying then goes down, that contract gets nuked. So like you're taking the lower the volatility, the higher the risk. And that doesn't seem to make any sense, right? But that is how it is. And higher volatility contracts maintain their premium much better. And so like, here's like basically the worst thing that can happen to you is somebody is monitoring your trades and they see that you just bought a ton of low volatility options that expire in like a couple of weeks. And what they could do is lock you in that box because they don't have to move the price that much for the box to lock. Okay. And all they have to do is like get to the technical level, do tons of selling pressure and, like try to break down. Of course, if there's like tons of buyers, you can't do it. But in the absence of buyers, or like, I think the default is bearish. I think like we need a reason to buy. There isn't always a reason to buy. It can be earnings, it can be news, whatever. But like, there has to be a reason to buy. There doesn't have to be a reason to sell. Everyone wants money. And so, but yeah, like that's what you could do, is you could lock them in the box and you don't have to move the price that much because there's no volatility. Like you couldn't do that to a high volatility stock. Like an example would be ARK, right? ARK has pretty low volatility on the ETF. If it drops $5, the contracts get nuked. But if it goes up $5, the contracts are more reactive. Tesla or Nvidia or Coinbase, those are going to have higher volatility. And so they're going to maintain their premium better. And, this is the kind of stuff we have to learn and we have to be aware of as we're considering not just our trades, but our positions. And, how long do we hold a position? And why that strike price, and why that expiry time, and what is the cost of the option, and what is the cost of not having the option? What is the risk to the upside and the downside? Always considered. And I think following like what these guys do on this side is kind of easier to see, is a good idea of how to get there. And so yeah, we can look at the dark pools real quick, see if there was anything crazy. $1 billion, that's not a little amount. Into QQQ, not anything crazy. Let's just see Nvidia and see if there's anything interesting. Nvidia had quite the day. I did want to look at their chart. 500. Yeah, it's another $1 billion right into close. Why do they always do it right at close? Maybe there's something well, that's not quite. No, that is. Anyway, maybe that's the chart. Let's look at Nvidia real quick, and then we can wrap it up. So Nvidia. Yeah, Nvidia wants to be 500. It wants to be 500. And all this is new price history, which is interesting. We're in, dare I say, I won't, but like we're in new price history, right? You say it. We're in new price history. And so let's just look at the trend is trending. Okay, so the slope is actually not even that off track. It's a little bit higher. The slope is now below. Nvidia is probably a really good buy. I'm pretty bullish on Nvidia these days. Like they really do have a chance to be a big tech player, and we love having another one in the crew. And so it'd be cool if we could make like the Magnificent 7, the Suplificent 11. That's not a word. So anyway, like what's going to happen in Nvidia? Well, where are we going to be buying calls and selling puts tomorrow? We're not going to do anything until we're going to do a ton, but like we'll try our best to like, reserve what we can for when the Federal Reserve is speaking. And what is going to happen to the price? There's too many people that want to participate in Nvidia. You're crazy. You're crazy if you think you can keep Nvidia down. Like it has defied every price level, and they just like raised the most bullish guidance in the universe. It's going to be bananas. It's going to be a bonanza. So look at this. Boom. Look at that level. I love seeing that. That's what keeps me really looking at these charts. So we get this giant red bar down. Like there's too many buyers. There's way too many buyers. And this is all pre-Fed hedging. That's what that is. And it might be a really good hedge because maybe they're like, hey, interest rates suck. We're going to double the rates again. Mortgage rates are 20%. They could say that. They really could say that. But, they probably won't. They probably won't say that. And, this is interesting. Okay, so here's what's cool. We're at new price history since our highest previous read was $479.58. Is that true? Right? Is that all time? Let's go double check and confirm. All time price is that up here. Boom. 480. All right. Anyway, it doesn't really matter. What the all-time high is there. Anything above 480 we can call new ground. So did this get to new ground? This candle here. This was Monday. Let's go to today. What did we get to? We were at 510. No, that's not right. We were above 500. Yeah, 502. So we didn't actually have a candle read above 500 for more than a minute. But that's because the smartest money sold on that, right? Obviously there's going to be a giant selling wall on 500, and that is just those guys have to get paid for being in the stock so long. And so we'll get all those guys paid up, and then we can fucking cruise above 500. And the question is, what does NVIDIA want to be? So they're doing dividends and buybacks, and they're printing cash, and they're developing new lines of product and technology, and they're literally at the center of the global trend that is about to change the world, artificial intelligence. And all of this is, let's see if we can make something happen here. Looking so we were here, and then we want to be here. So what is that? That looks up and to the right to me. That doesn't look down. Let's go back a little bit. The trend keeps trending, right? That's why we sold off for a week before we had any kind of a break in it. Maybe we are in a bull market or whatever. It's possible. It's possible AI is fake, right? Might not be real. No, that's crazy talk. AI is real, and NVIDIA is going to make, so much money that they could compete with China or Japan or most countries that aren't America. I think actually Japan has a really big GDP. I think it's third. I think it's US, China, Japan. It should be US, Russia, but they can't help but, stalling themselves. That's what they do. It's a, time-honored tradition. Who am I to judge nation? So anyway, that's kind of what I see happening with the price and all this stuff. Here's an example of no man's land. Coinbase, no man's land, right? I don't have any kind of I could go back through history and find where we're, find some stuff, but I guess I haven't. But yeah, Coinbase, I think after 270, this is a hard line, $73. I think I did see a giant shaft up at 73. Let's see if we can find it. 73 is probably right. Where is that? Is that way back when? Wow. I guess I can't find it right now. It can't be that far back. 73. It's got to be right there. Let's see. This one, zoom. Okay, there's 73. So that's not quite anything. Usually I mark that with when it's at the bottom of something. So I don't know what that's marking the bottom of. But 73 is, but usually, I mean, I did this once today. So, that's what I thought I did. Anyway, yeah. This is an example of no man's land because we were at 115 and 40. The spread in Coinbase is crazy high, but that's also what it is with Tesla. And that's what happens when you get a ton of options action is the vol goes up and there's more participants, and people like playing the options on those chains because it's more stable. You, like I was saying, like you actually want to buy an option that has higher volatility and that's going to be more stable. And I still have to try to work out exactly why that is. I think I don't understand exactly why that is. But I know that if you buy like the $1 call, it's going to have like a volatility of like 2000%. So like you could if you bought the $1 call on Nvidia, you could buy 100 shares for $100 and $1 a share. And so that would be like, it doesn't quite make sense. Of course, like anyone would be happy to pay $100. Why is the implied volatility such a big number there? So the number might be a misnomer in some ways, but still trying to figure out that one. And I'll let you know when I have it figured. But for now, like what I really am trying to develop is a set of tools and processes to help me become better at this world. And that's what I want to share with you guys. One of the ideas I'm most excited about, I cannot wait, is I do coding. I do a fair amount actually, and have for a long time. And so one of the things I'm making is a central market service that is piping in data from multiple sources, like 5 different sources, and unifying it into a single stream. It's called Market Flow. And it's going to let me look at any contract in real time, and I'll be able to tell you literally in real time everything about it. Not just like the price, but the history and the all of the indicators. Like what I need that for, practically speaking, is this idea called delta hedging. So with a trading API like Tradier, you can buy options through a network call, which is like how the big boys do it, right? You don't launch your fireworks by hand. You have a launcher. And so, of course, but they have programs doing all of it. It's all automated. And one of the things that I would like to try automating that I think would be pretty safe to try is automating the delta of my portfolio. Now, none of this stuff is easy. All of it is tremendously complicated. But even just in the exercise and the effort to understand all of this, we'll learn and improve and get better results. So the delta is the kind of the probability that the price will finish and in the money, like with value. And you want a contract with a lot of delta, because delta is like how much the actual price of the contract is going to change per $1 of the underlying unit. That's what it actually is. The first thing I said is like how to think about it. But yeah, what delta actually is how much the price of the contract will change for every dollar the underlying moves. So that's a really important number because it can change dramatically. Like you can have a 99 delta that just like gets nuked down to 50 if the stock price goes $10 lower. And so delta, I don't think it's even that it's so sensitive. It's just that it's a really good measure of the likelihood that your portfolio is going to be valuable. And if your delta is like rapidly declining, that's a really good signal something is deeply wrong. And so like, which is price, right? It's just price. But like these things happen so quickly. I think you have to measure them by the Greeks. It's different with shares. And so like, it actually, because it takes into account the expiry time and the strike price, it's different. I think you could actually create virtual shares and hedge those, you know, like create a virtual contract based off your shares. What's your cost average? That's your strike price, that kind of stuff. So, and then you could hedge with that. You could delta hedge with that. And so like delta hedging is getting a live socket feed of all of your positions delta as it's changing in real time. And you don't do anything if it goes up. If it goes up, great, that's awesome. But if it takes one fucking point lower than the previous close, just one tick, then you buy the smallest of puts. Nothing really, just like a 2025 $1 on Tesla. It's probably like $5, but still, like, let's see what the delta is on it and what the cost is. So let's say you wanted to be able to take on more risk. Well, you got to be able to manage that risk, right? And that's a lot of what you're paid to do in the markets, is to manage the risk. So you're going to get paid more if you can manage it, more risk effectively. And some people think they can manage risk and then they blow up. And so the cheapest call on what? That can't be true. Oh, buy put. Okay. It's 7 cents. It's 7 cents in options land. It's 7 cents. So you can buy a $5 put right now. That's free. Oh my God. I want to buy that. Holy shit. You can buy a 2025 option against bankruptcy right now for Tesla for 7 cents with a strike price of $5. What's the delta? Okay, you're getting a 0 delta with that. Damn. Okay, that's not going to help us. So we need actually some delta. This is why we got to it's not easy, but in concept, it makes a lot of sense. To put it into implementation takes some work. And that's work I'm signing up to do. Okay, so here's the $5 one. That's like delta a -12. That's pretty good delta. So let's just take that as a ratio. Obviously, it's going to depend on the chain, but 0.12. So you can buy it for like $40 per point at that point on the chain. Or is it the opposite? Anyway, like the point of delta hedging is you monitor the delta of your portfolio in real time, and anytime it drops, you buy the opposite. You could delta hedge with a bear portfolio. So you have all this negative equity. If that equity gets too high, or just the way I would do it is like, look at the previous day's close. If like we only want to go up, right? That's all we want. And so if it's lower than the previous day's close, then roll into these puts, which by the way are valuable anyway. They're already good to have. And if you buy, I think the right put, it can actually increase in value as volatility rises. And so I think there are some conditions by which you actually it's really good to have puts. And so, or sell calls, like one of the things I played with, and this worked out, like not in all ways, but it could have worked out great if I had timed it even a little bit better. But it didn't work out bad as it was. So a lot to be grateful for. So I took a position in NVIDIA because of the excitement that I've had talking about them. And I've always been interested, and I've been, in and out for years. And so I just want to get in again. And what I knew from doing this the wrong way is seriously, is that the option contract prices for NVIDIA were about to fall in half, all of them. And so I couldn't buy a put because even if that was like at the money, the vol was going to get crushed to nothing and the put would be pointless. That had happened to me before. And that had also happened to me with sold calls. And so this time I assumed that the volatility would crush. And let's see what the return is. Okay, yeah, I'm basically up. I'm basically up on the sold call. Now it helps that NVIDIA is at the lows. But if NVIDIA goes at all lower tomorrow, then on that one trade, I will have made money shorting NVIDIA while the price went up, which is crazy. That's crazy. And so it basically means like a certain amount of free shares. It's not a ton, it's probably like, what is it? Like, a couple $100, whatever that is. Yeah. $700 or whatever. And so, but still just the concept matters. That's what matters. I'm sure I could have done it 10 times better, but I still had a like it's almost a break even on both. So it's like nothing to, it's nothing to celebrate really. But the thing to celebrate is the learning. And the learning is not to buy a put into a volatile company right into their earnings. It's not going to do anything for you. You had to already have that put, which is the other side of the conversation that the other side of the idea that I've been talking about, which is like puts can actually accrue value as the market goes up, which is very different from calls. That will never happen. Well, I guess it can, but like, can an inverse call? I don't think it could. Like, calls will, but just because the volatility rising is good for all option prices. And I think volatility is actually falling. So in some ways you can look at it and be like, it's cheaper, things are on sale, or in other ways it's like a better time to sell. So, yeah, I thought that was a very interesting outcome. Is I purchased shares, and then those shares are up because the stock is up. Now maybe it's not up for long or whatever, but just this is in concept, nothing to do with like any success, no success, like, but the success is in the concept. And so, yeah, so the shares are up and the sold call is up. That should be impossible. I've sold a lot of calls. That should be impossible, but it's not because the vol got crushed. And so like, that's the kind of stuff I want to learn more about and share and capitalize on. What would I do with NVIDIA? Yeah, like I put some premium into the calls like everyone, and it was just such a dumb move because I knew what I know. And I bet the vol is going to crush for like the next 2 to 3 days. So like in NVIDIA, I wouldn't hold options for more than like a couple of hours for the next couple of days, just because the vol is like going to crush them down no matter what. Unless we're just going to gap up into the open, and that's not going to happen. People are rationally hedging ahead of the Fed. And I think that the way that they are doing that is with, they're getting it both ways. They're calling up the names that they like, in case of a surprise to the upside with, the names that they like. And then they're hedging their downside through the QQQs, the SPY. I think that's how you do it. I'll try it out. I'll return a report, let you guys know how it goes. We should look at what the most premium was, and then we'll close with that. The most premium goes to hedges. Let's get rid of the hedges. So Splook. Let's look it up. Splunk. Where's my thing? Splunk is this company. Ooh, they got some green bars. Splunk. The power of Splunk. Downloads. It's a tech company? Well, I don't know. Whoa, they're a big company. So Splunk is getting called up. Interesting. Let's see what else we got. Okay, so this is very interesting. If we take out the QQ, this is what I'm talking about with the day's action. It's bullish. It's bullish. It looks bullish to me. If we take out the hedges, which is the SPY and the QQQ, which, by the way, we can double confirm on that, is look at what they're doing on the bull calls. They're calling up NVIDIA. They're calling up Tesla. They might gap and open. I don't know. I doubt that. That can't be. They're going to wait and make sure that the Fed doesn't nuke the markets. If the Fed does nuke the markets, they're going to sell everything instantly, and it's going to be like the highest volume red candle of, just whatever, a big one. But if everything is normal, then I think it is more just bullish action, which is what we've been seeing. And so it's disguised though. If you like were only to look at the order flow by the numbers, you would think it would be bearish. But if you look at it by how is the premium being deployed, I think it still looks bullish to me. Not that, anyone should make a decision based off that, including myself. We're learning on the station. So learn. Anyway, it's also good to just see what names people like putting. Like Palantir, there you go. Disney is always getting put. Apple, Google, interesting. So yeah, that's about the show. Thank you guys for hanging out. We'll talk more about delta hedging and we'll see what happens with the markets tomorrow. And yeah, I'm interested in developing this set of trading tools and sharing the processes and the things that I learn along the way. Hope you find that valuable. If so, like and subscribe and send me some Bitcoin and do something good. All right, see ya.